Moving on now to tactical asset allocation itself, the main purpose behind this whole presentation. Tactical asset allocation, or at least my version of it, attempts to improve on the index tracker by dynamically adjusting portfolio holdings according to market conditions. So ideally, an investor would like to exit risky assets like stocks and commodities during times of market crisis and switch over instead to take refuge in cash or short-term government bonds, preferably not Greek bonds or those of Imperial Russia. But the chart at the top right that you can see there is the result of applying one simple asset allocation rule, dynamic asset allocation rule, to that list of 22 stocks that we saw a few moments ago. And that rule is that you invest equal amounts in each of the 22 ETFs in the portfolio, but you take a reallocation stance once each month. So if at any given month end the investment has shown a negative return over the previous 12 months, you exit that investment and you reinvest the proceeds in risk-free cash or short-term bonds. The following month, if the investment has shown over a 12-month look back a positive return, well, then you re-include it again at an equal weighting of the total portfolio value. But the real point about this is when you look at that chart, you can see a much, much smoother progression of your portfolio value. It happens here that the return is higher at just over 8%, but perhaps more importantly is the standard deviation, a measure which many use to judge risk. Standard deviation here is under 10%, and on the simple buy and hold method you saw earlier, it was greatly higher than that at 14%. Equally important, look at the maximum drawdown here. It's 18% as opposed to over 50%. So look, you can see what you've done after the tech crisis in the late 90s, and then in 2008-9. What you do here using simple rules like these is when the markets are going south, you exit to the reserve asset of cash and bonds. And you can see from this chart below the progression of the portfolio over time. Look at 2009, where the S&P and world markets recorded vast drawdowns, 55% for the S&P. Some emerging markets were down as much as 80% at that date. Well, you can see here that by that time, the portfolio is wholly in cash. As you can see, the portfolio increases exposure to risk assets during bull markets. It reduces exposure to risk assets in favor of cash when the climate deteriorates. So it would be misleading to say that, to suggest that it always works out this perfectly. There will be market conditions where a system is going to be fooled. If there's a very sudden, very dramatic collapse, probably nothing is going to save you other than diversification. Your stock holdings are likely to take a very severe beating. The other thing one ought to say is that backtesting, and that's what I've shown you here, it's backtesting of rules over historic asset prices. Backtesting can be a very dangerous tool. You can fool yourself with it badly if you start adding complex rules to try and fit specific disasters in the past and to avoid them. Very easy to fool yourself, but a few simple rules should hopefully give you a sporting chance of avoiding at least some of the worst volatility of a buy and hold approach. Moving on, you should be aware that there are many tactical asset allocation strategies. I mention a few here. Mean variance optimization, that is the classic approach devised by Harry Markowitz back in the 50s. Nothing wrong with it. It's perhaps fallen out of favor, but it can be put into a system and operated very successfully. Simple equal weighting at every month. Instead of buy and hold each month, you reallocate the portfolio equally. You have an equal holding in each of the 22 assets, for instance, in that portfolio. Works nicely. Fairly high volatility, fairly high drawdown, but it is a very simple tactic. Risk parity, bottom left corner. That is something which has been put to great use by Ray Dalio and the massive Bridgewater Fund. They practice a risk parity approach. Bottom right corner, volatility adjusting, very similar to risk parity. That's the approach that the vast majority of trend followers and commodity trading advisors follow. They will adjust their position size in accordance with perceived risk and volatilities in the markets. And I think many people will be probably familiar with some of the major trend followers out there. So there are, and also, sorry, top right-hand corner, you might optimize your portfolio for maximum Sharpe ratio. So it's a question of tactical asset allocation. It's a question of wide diversification and also tactics to try and reduce volatility and reduce drawdown. As a conclusion, I have to say again that nothing is foolproof, no method is foolproof, no algorithm is going to keep you out of all trouble, no portfolio will ever be able to protect you against all eventualities. But in the realm of the practical, if you diversify widely over markets and asset classes, you should be well served. I may also say that you need to diversify across funds and fund managers. You need to diversify widely across service providers. You shouldn't put all your money in one bank. You shouldn't put all your money with one fund manager. You shouldn't put all your money with one broker. We've seen so many instances in the past of disasters. I myself was caught up with a lot of my personal assets in MF Global, which of course went spectacularly broke back in 2012, I think it is. Fortunately, I was diversified. Fortunately, I got 95% of my money back. But the fact remains, you have to diversify very widely, not just over asset classes, but across service providers. If you do that, you've really done the best you can, and you can hope at least for some measure of tranquility in your portfolio and some measure, hopefully, of good performance or at least decent performance in the future. So thank you for listening to my brief presentation.